Let's get started with the conceptual and regulatory frameworks that govern financial reporting. What is a conceptual framework? A conceptual framework will form a theoretical basis for determining how transactions should be measured and reported, that is, how they are presented or communicated to users. These concepts allow for better flexibility in dealing with complex and ever-changing modern businesses instead of a rule-based approach where modern transactions might escape through loopholes. Remember, the conceptual framework is a principles-based approach. What does the framework consist of? The content of the framework can be summarized as follows. Number 1, identifying the objective of financial statements, meaning why do we prepare financial statements. Number 2, who is the reporting entity who should make financial statements, all right, basically. Number 3, identifying the parties that use financial statements. Who are the stakeholders of our financial statements? Number 4, the qualitative characteristics that make financial statements useful. Number 5, the remaining text of the old framework, dealing with elements of financial statements such as assets, liabilities, equity, income, and expenses, and when they should be recognized, and a discussion of measurement issues and the related concept of capital maintenance. Next, who produces these frameworks? Basically, the IASB produces these frameworks. What is the purpose of this conceptual framework? Meaning, why do we have a conceptual framework in place? Basically, there are 3 major reasons, and please note down the key words, all right, which will help you in revising and understanding this much better. Number 1, assist in the development of future IFRS and the review of existing standards by setting out the underlying concepts. All right. Next is to promote harmonization of accounting regulation and standards by reducing the number of permitted alternative accounting treatments. Basically, to reduce confusion and to bring about consistency. Okay. Number 4 is assist the preparers of financial statements in the application of IFRS, which would include dealing with accounting transactions for which there is not yet an accounting standard. Next, advantages for companies using IFRS. This is basically why should a company use IFRS for its accounting and reporting. Number 1, IFRS are widely accepted as a set of high quality and transparent global standards that are intended to achieve consistency and comparability across the world. Number 2, they have been produced in cooperation with other internationally renowned standard setters with the aspiration of achieving consensus and global convergence. Number 3, companies that use IFRS have their financial statements audited in accordance with international standards on auditing and will have an enhanced status and reputation. Number 4, it is a principles-based approach, so it is more flexible and broadly applicable. Number 5, the International Organization of Securities Commission recognizes IFRS for listing purposes. Thus, companies that use IFRS need to produce only one set of statements for any securities listing for countries that are members of the International Organization of Securities Commissions. This makes it easier and cheaper to raise finance in international markets. All right. The 6th advantage is that companies that own foreign subsidiaries will find the process of consolidation simplified if all their subsidiaries are using IFRS. Okay, so thanks to the consistency, it becomes very simple for them. Number 7, companies that use IFRS will find their results are more easily compared with those of other companies that use IFRS. This should obviate the need for any reconciliation from local GAAP to IFRS when analysts assess comparative performance. Moving on, what is the regulatory framework? The International Financial Reporting Standards is the regulatory framework developed by the following bodies. Number 1, the IASB. Number 2, the IFRS Foundation, which oversees the IASB. IFRS are a set of accounting standards that govern how particular types of transactions and events should be recorded and reported in financial statements. They follow a standards or rules-based approach and should take precedence over the conceptual framework.
What is the objective of financial reporting? So the objective is to provide the best information for decisions relating to primary users. Primary users are existing and potential investors, lenders, and other creditors. Because primary users base their expectations of returns by analyzing the following factors. Number 1, the amount, timing, and uncertainty of future net cash inflows to the entity, which is basically the cash flows to the entity. And second, the management stewardship or the ability to use entities' resources. Now, because primary users base their expectations of returns by analyzing these two factors, financial reports must help them gain these insights so that they make the best informed decisions. There are two fundamental qualitative characteristics. First is relevance, and for information to be relevant, it has to pass two criteria. 1. Information should have predictive and or confirmatory value. Number 2, it should be material. Materiality is entity specific and depends on the magnitude of items in a financial report. For revision purposes, as per IAS 1 para 7, the definition of materiality is information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary users of general purpose financial statements make on the basis of those financial statements. Moving on to the right side, the second qualitative characteristic of financial reports is faithful representation. Financial statements can be said to be faithfully represented if they pass three criteria. 1. Information should represent the substance or context of an economic phenomenon and not just its legal form. Maximizing characteristics should also be achieved for faithful representation. Information should be complete, neutral, and free from error. 3. Neutrality and prudence. Neutrality is supported by exercising prudence under conditions of uncertainty. IFRS also defines prudence as an exercise of caution when making judgments under conditions of uncertainty. The exercise of prudence means that assets and income are not overstated and liabilities and expenses are not understated. There are four qualitative characteristics of financial statements that further enhance their quality. First, comparability. Information is more useful when it can be compared with similar data from other entities or different periods for the same entity. This helps users identify similarities and differences. Second, verifiability. This ensures that information faithfully represents economic phenomena. Different knowledgeable observers should reach consensus. Third, timeliness. If information is not provided on time, it doesn't render much value. So it should be available on time to influence decisions. Fourth, understandability. Clear and concise presentation makes information understandable. Some complex information must be included even if inherently hard to understand. It is assumed that users of these reports have reasonable knowledge and diligence. Underlying assumption of IFRS. The IFRS framework states that the going concern assumption is an underlying assumption. Thus, the financial statements presume that an entity will continue in operation indefinitely, or if that presumption is not valid, disclosure and a different basis of reporting are required. What are the elements of financial statements? Financial statements portray the financial effects of transactions and other events by grouping them into broad classes according to their economic characteristics. These broad classes are termed the elements of financial statements. The elements directly relating to financial position are assets, liabilities, and equity. These are included in the balance sheet. The elements directly related to performance are income and expenses. These are included in the income statement. The cash flow statement reflects both income statement elements and some changes in balance sheet elements. Now let's look at the key definitions that will help us categorize financial events and transactions. First, we look at elements of financial position. First, assets. An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. Number 2. Liabilities. A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Number 3. Equity. Equity is the residual interest in the assets of the entity after deducting all its liabilities. It is very important to note down the key words of these definitions. Next, now we'll look at the elements of financial performance. Income is increases in economic benefits during the accounting period in the form of inflows or enhancements of assets, or decreases of liabilities that result in increases in equity other than those relating to contributions from equity participants. Second, expenses are decreases in economic benefits during the accounting period in the form of outflows or depletion of assets, or incurrences of liabilities that result in decreases in equity other than those relating to distributions to equity participants. Now that we have covered the theory, basic definitions, and concepts, let's continue learning. I encourage you to subscribe to stay tuned as we upload every day to make accounting easy for you.